I'm Jeff Clark, for those that don't know, with the new Paydirt Prospector, and I'm going to have a little fun with my presentation today. Yes, this is the comedian's guide to junior stock investing and why the Jester, why we will get the last laugh. So let's see if anybody knows. What stand-up comedian is that? Does anybody know? Bill Burr, right, thank you. Bill Burr says, if I owned a bookstore, I'd have all the mystery books hard to find. That's what he says, so that's pretty good. All right, the comedian's guide to junior stock investing says, investing in junior miners is so bad right now that what? You have an IV stand of antidepressants right by your desk as you watch your stocks. Investing in junior miners is so volatile that you have to take Dramamine every day, motion sickness medicine every day. I told my friend who wanted to invest in junior miners, hey, Rick Rule says, go big or going home. He says, I'm going home. How many of you feel like that sometimes, right? A client asks his broker, is all my money really gone from junior miners? No, of course not, the broker says. It's just with somebody else. Remember, if you sell, somebody else is buying. Investing in junior miners is worse than being a Bernie Madoff client. Did you know that, I didn't know this till I looked it up, that Bernie Madoff clients actually eventually got 91% of their money back from investing in his fund, eventually, right? So I'll make you a deal right now. I'll give each one of you 91% of your money back on all your junior miners right now, all the ones you're underwater, everything. I'll give you 91% of your money right now, but you got to leave the sector. How many of you would take that deal? Huh? Okay, here's why I think you shouldn't take that deal, why we, the Jesters, will get the last laugh. I have 5 reasons why I think you should be bullish on gold and gold juniors right now. First, the Fed is going to have a direct impact on gold. Some others have talked about it. I'll give you my perspective. Chinese gold buying has ticked up substantially. I'll show you that. I'll put it all together. Silver fundamentals are brewing. I have some new charts that I don't think have been seen elsewhere. I'll share with you. There's a generational disconnect between gold and the juniors. I'll show you why I think that's going to correct and how much. And I think our strategy, regardless of what market conditions do, if I'm wrong about everything else, our strategy can trump market conditions. And that's why I have these 4 gentlemen up here. Number 1, the Fed has a direct impact on gold. Gold usually rises during periods of interest rate easing. Now, the charts are grayed out, but all the returns you see up there, the figures, are the percentage gains that gold made during periods of Fed easing, when the Fed was either lowering rates or not raising rates. So when the Fed is dovish, this is what gold has done. Out of the last 11 periods, gold has risen in 9 of them. Gold stocks also like easing. During the last 3 periods, the Fed lowered interest rates. This is what gold stocks did. And you can see there, my screen's blacked out, but the gains averaged 282%, if I'm reading that right. In the last 3 periods of gold easing, gold stocks, or Fed easing, excuse me, gold stocks rose that average the last 3 times. And of course, as I think many in this audience know, when the Fed breaks something, gold rises. So the chart on the left there is gold during recessions. Of the last 8 recessions, gold has risen in most of them. Some of you say, what about gold stocks, Jeff? That is the stock on the right. This is what gold stocks have done during recessions. And you can see out of the last 8 times, gold stocks have risen in 5 of them. Gold usually rises during stock market crashes. If you fear a stock market crash, this is what gold has done in the last 10 stock market crashes. That's all the ones in red there that you see. And then on the right is what gold did. Green means it rose during the stock market crash. Red means it fell more than the stock market crash. Yellow means it fell, but not as much as stocks. And what I'd like you to look at is the bottom average there. The average since the 1970s is when stocks crash, they lose about 1/3 of their value. the average for gold during those periods is a 19% rise. And by the way, how are they going to keep paying for this? You've probably seen charts like this before. This is updated just as of last week. This is federal interest payments on the debt. How are they going to continue to keep funding this? Well, I have a solution. I bet you they're going to print money. I bet you're going to print currency, right? If I had $1 every time the Fed devalued our currency, I'd already have 25 cents by the time I was done reading this. But that's just my 2 cents, right? That's what they're going to do. Number 2, the year of the dragon. A lot of things are happening with China that I want to put it kind of all together. There's one big message or picture that's happening in China right now. China isn't dragging their feet. It's the year of the dragon. They're buying. This chart shows gold reserves, official gold reserves. I mean, most people think their gold reserves are higher than this, but this is the official gold reserves as reported by China. For the past 14 months, they've added to them, 14 consecutive months in a row. You can see what that looks like on a chart. That's what the green bars are. They've been adding to their reserves consistently every month. This is Chinese gold ETFs. That's what the green is. This represents ETFs. You can see ETFs in China for gold just reached an all-time high. They've been buying aggressively. Shanghai Gold Exchange withdrawals coming out of China have been going up. The top part of that chart shows the cumulative effect, but the bottom shows the monthly. And if you look at the bottom, look at the far right bar, you can see that is the second highest withdrawal of gold off the SGE in its history, the second highest ever just last month. Meanwhile, you have gold exports from Switzerland going to Asia and the Middle East. The biggest part of that is China. That's what the bar on the far right is. That's the biggest jump they've seen in years in gold exports leaving Switzerland, going to China and the Middle East. Largest in a long time. Okay, the silver market is percolating. I want to show you this, put some charts together, but first, silver's doing so poorly, the Olympic Committee is making the silver medal what? What are they making the silver medal since silver's doing so bad? Transitory. You can keep it until Tuesday. I love that joke. This is the time, I wanted to throw this up real quick. This is the time between silver spikes. Silver historically goes on spikes. The last one was during the COVID bounce back in 2020. Okay, but this is how long it is between each of those spikes. And I want you to look at the bottom bar, the average there. 3 years and 7 months is the average time between all the silver spikes going back to the 1970s, okay? When was the last silver spike? Well, it ended in September of 2020, as many of you know. So 3 years and 7 months would be April. So April Fools, everybody. Be ready. Okay, here you go. This is some things I wanted to put together about silver because it's really compelling. Mine production and total supply are in huge downtrends. Look at the chart on the left, that's silver mine production. And this is global production. This isn't primary silver producers or anything like that. This is total global silver production. And you can see how it's down. Silver mine production will be down 8.8% since 2016. Why is it going down so much? Total supply is downtrending. That's the chart on the right. Total silver supply will be over 5% lower than 2014. Supply is clearly in a downtrend for silver. This is not a one-off. It's clearly in a multi-year downtrend, while demand is higher. Look at the chart on the left. This is total demand. You can see the demand for silver is rising over multi-years. It's going to be, 7% higher than 2013 and 17.7% higher than 2017. Demand is really ratcheting up, and it's in a clear uptrend. What does this mean? Supply falling, demand rising? That's what the chart on the right shows. This is the silver market deficit You can see the red over the past 4 years, 4 consecutive years in a row, silver is in a deficit. If you add up all 4 years, the deficit in the silver market is basically 2/3 of 1 billion ounces of silver in just 4 years. How does this trend continue without eventually affecting the price? That's the question I have. And here you go. Silver, I showed you what gold did over the last cycles. Here's what silver's done over the last 3 Fed rate cut cycles. Look what the silver price has done. Look at those gains just over the last 3. Number 4, history says the disconnect between gold and the juniors will reconnect. Even if you just believe in reversion to the mean, and we're not going to go into some sort of mania or something like that. Look how undervalued things are right now. The left is the HUI index relative to gold, its ratio to the gold price. You can see it's near historic lows. The chart on the right is GDX. It hasn't been around as long, but that's its ratio to gold, also near historic lows. This chart shows from Prescott Capital what could happen to juniors if they just return to the mean, just reversion to the mean, if they just go back to where they were. Gold is the gold line. The venture index, where a lot of our juniors live, is the blue line. You can see there would have to be a 548% appreciation just for the juniors to get back as a group to where they were in 2007. So my question is, what happens if the gold price moves substantially higher in the meantime? John Hathaway at Sprott, I think that's a well-known name. This is the greatest disconnect I've ever seen, and that's saying something for someone, well, I don't want to say someone his age, but he's been around a while. But that means something. It's coming from someone who's been through multiple cycles. Higher gold prices will generate interest in the miners because they provide leverage. So once gold prices begin to rise again and break into new all-time highs, maybe like today, and they stay there, they're above 2,100 for a sustained period of time, that's going to draw the generalist investor back into our industry. It's Stanley Druckenmiller, you probably know that name. You may have heard this piece of news. He's actually selling the Magnificent Seven, a bunch of tech stocks mostly, and he just bought Newmont and Barrick. And his track record, by the way, is actually better than Warren Buffett's. Quote, we could see the combination of a dot-com type crash and another global financial crisis simultaneously, and that would force investors to look for other options, including metals and miners. Number 5, this is probably one of the most important slides I can say at a conference like this, because our strategy is more important than market conditions. Our strategy is more important than market conditions. So what drives performance in gold stocks? So this Resources Policy, a journal, did a big long-term study. They looked at over 300 stock performance of 300 stocks. They looked at all the ones that did what the industry did, and then they looked at those that outperformed. Why did they outperform? That's what they wanted to know. So let's read this quote together. We parsed out the extent to which a mining firm's returns are driven by industry-level price fluctuations, and hence largely out of management control, versus by factors that may allow for more management influence, like what these gentlemen are going to do. We found that industry effects drove the performance of average firms. However, company effects drove the performance of firms that captured the biggest gains. In other words, a discovery or a significant advancement of deposit despite market conditions. So if you just want industry effects, we'll just buy GDXJ. But if you want outperformance, we need to focus on companies that can have a specific effect on their project, on their company, to really ignite the stock. This shows, can you see it? Oh yeah, okay. And again, I'm not beating my chest here, but you know, my mining portfolio was actually up last year in one of the worst years for sediment in the junior miners. Again, I'm not beating my chest. But I wanted to show that you can still win even when the sediment is poor, even when most stocks are poor. And those are some examples of the gains I logged last year. Some of them started from years before, but I took profits on them last year. So that shows you stock picking can work, and we can really have a winning portfolio. So if you add it up, sentiment doesn't reflect what's happening in the background. It doesn't reflect reality, and it doesn't affect our strategy. The Jester, us, we will get the last laugh because the Fed is going to eventually, whether it's this summer or later in the fall, whenever, they're eventually going to lower rates. Maybe they'll be forced to lower rates sooner than they thought they would be, depending on what happens. But when they do, that is very favorable for a move in the gold price. China is stewing, silver's boiling, the disconnect will reconnect, and our strategy can prevail above everything else. Okay, so what do? This is actually probably the most important slide because a lot of us are down on many of our juniors, right? So what do? I think you have to do three things. And I think, given where we're at, you have to do all three things. First of all, you have to sell ones that just aren't going to make it. They're not going to rebound. So as I say there, number one, sell the likely losers. Will the market care if they do anything? Okay, so you have to really examine whether or not you think the market's going to care. If a CEO tells you that the primary catalyst for his stock is a higher metal price, whatever metal it may be, that's a gong. That's a number one gong. I interviewed a CEO years ago, I'll never forget. He kept saying the metal price was going to be the major catalyst. So later on, I asked him again, what's the major catalyst for your stock? A higher metal price. I never bought that stock. And by the way, it didn't go anywhere. It's going to be harder. This is controversial, but it's going to be harder for old names, the ones that are struggling, the names that have been around a while, to outperform. And that's why you have to do all three of these steps, okay? Number two, hold the likely winners. Is management aggressively pushing forward despite market conditions, despite what's happening in the market and to the metals price? Are they aggressively pushing forward? So how do you know what to do between number one and two? How do you know? Well, obviously you can subscribe to a newsletter, whatever the case might be. But here's an exercise you can do right now that will help you answer that question. Right now, I want you to cut your portfolio in half. You have to sell half your stocks. I'm going to make you sell half your stocks, okay? You have to sell half. Would that help you decide who is a better stock, which one is more likely to prevail, okay? Now, I'm not actually saying you have to do that, but if you went through that thought exercise and actually looked at your portfolio and examined it, and you had to get rid of half and focus just on best of best, okay? That might help you decide what to sell and what to keep. And number three, what we're all here about, and that is you have to buy new candidates. I think you have to do this step. You can't just hold on to the same old names. And I know a lot of investors at this conference would do that. But you have to buy new names. In fact, I think you're going to have to get used to that, in my opinion. We're going to have to always buy new names, okay? And that's not where you're going to put all your money, okay? We're not going to be irresponsible and throw all of our money into them. But you do have to buy new names. And I think I have some of the best right here. Okay, new candidates to buy. I have them here for a reason. Argentina Lithium and Energy. High prospects for a discovery. This is backed by Stellantis. Miles is going to tell us about that in a minute. Erdene Resources in pre-production right now. This is a huge asset in underexplored Mongolia, backed by MMC. You'll hear more about that. Strike Point Gold, maiden drilling in Nevada on 2 major discoveries, backed by a team who's made multiple discoveries in Nevada before. And Kraken Energy, a uranium, drilling a brownfield project now in your team, with a team that's made multiple discoveries also in uranium before. So I have multiple resources on the website. Goldadvisor.com is free. There's picks on there. We provide free analysis. Number 2, the Paydirt Prospector is a new pay letter that we're pretty excited about. It's going gangbusters. These gentlemen, their companies are all in Paydirt Prospector. They're good examples of what you would find in that newsletter. Last, I have the book Paydirt. It's out here for sale. If anyone is interested, we're offering a discount if you pay cash. So there you go. Thanks, everyone.